Hello, this is Dr. Paul Cottrell and student Dr. Paul Cottrell, and I'm going to discuss the market open for New York, March 23rd. Okay, so I'm going to go over the market, talk about a little bit about how you can manage risk and, in terms of how much cash you have in your trading account, and also how I made money yesterday. And a little bit more complicated strategy that's like a strat. I'll explain it. It's a straddle type position, sort of. And comment from a viewer about their opinion about how they interpreted what I said. Okay. So let's go with the market first. All right. So again, I look at risk indicators. I look at the VIX, I look at the currency movements, and I look at commodities, the oil trading, WTI. CL is the ticker. All right. So when you look at the futures market, we're seeing for VIX in the volatility for the VIX in the after hours, that is trading at this moment in time 21.5. All right, so it closed yesterday at about 22. Remember what I said, that when VIX is in the 15s, it's pretty much a steady climb, all right, in the equities. And usually equities and treasuries or bonds trade inversely related. Not always, but usually. So as the VIX is going up, equities have more stress and there's going to be more volatility. All right. So it's going to go down, or usually go down, but there could be mean reversions that take place. So when VIX is low, there's lower volatility. That's why it's kind of a steady climb. All right. There's a little bit of intraday, but if you look at daily or weekly, it's a climb. So when you look at VIX, when it's increasing, there's more volatility in the intraday. And I wanted to explain what happened yesterday. All right. But after I explain what's going to happen, probably going to happen today. All right. So VIX is relatively low relatively. It's still elevated compared to 15. It's in the low 20s. So there's going to be a bumpy road. We want that. All right. We want that. If you're just a buy and hold kind of person, you just put some money in and you just hold it to your event horizon. Maybe it's 5 years or 10 years and you'll make money and you don't even have to listen to this channel, but the whole point of my videos recently have been, how do you play the volatility? All right. If you're thinking that you're going to be able to trade the market exactly of what I'm saying, and that the market is just going to go up or go down for that day, you're missing the point. You have to look at the intraday volatility. And I'll explain the strategy I did yesterday. Okay, so VIX is relatively low. Compared to the close, it is lower risk on behavior. All right. In terms of the currency market, now remember, I look normally at the yen as the big indicator. All right. Yen is relatively weakening throughout the night. Now, as New York gets closer on board, it's strengthening a little bit through mean reversion, but the overall average trend through that night trading has been a weakening of the yen. That's risk on. That means people want to deploy money into the market in a long position. All right. So now you also want to take a look at what's going on in the euro because of the fiasco of Credit Suisse, some of the different central banks in Europe, Not everybody's tied to the ECB. And when you look at that, Euro peaked, Euro climbed throughout the US session yesterday. All right. Now, yeah, it continued to climb throughout the night and you know, was going up through the US session. So, and then overnight, it continued to appreciate relative to the USD. And then at about 2:25 last night, Eastern Standard Time, the euro started to weaken relative to the USD. All right. My understanding is one of the central banks, I think it's in what was it, Norway? Not Norway. One of the central banks in Europe just mentioned that they were going to do a rate hike, or did do a rate hike of 25. It wasn't the ECB, it was another one. I can't remember which. All right. So news is starting to unfold that there's tightening that's going on in Europe. Okay. So that was risk off for the European market in the current relative to the currency in the currency market. Okay, so something has transpired in Europe. I haven't really looked into detail what's going on in Europe, but something transpired in Europe to have a strengthening of the US dollar. All right. But the Japanese yen is weakening. And like I said, I normally go to the yen and not to the euro when you're looking at global risk, right? Even though the DXY is more heavily weighted to the euro, DXY is an index for the dollar, and it's a basket of currencies, and they're not all equally weighted. And the euro is more weighted, but I still look at the yen as a global risk factor. So you have kind of like a counter reading in the risk indicators that I'm talking about with this. So you have VIX is relatively calm, but elevated into the low 20s. The yen is weakening, and the euro is weakening. Okay, so I have oil now trading above 70. Okay, so the oil market's trading above 70, and the futures market is relatively flat. You know, a little bit up, a little bit down, depending on when you look. I mean, the last I looked, it was like +4 for the Dow. So it's relatively flat at this moment in time. So we have the futures market that's not really going in any direction. A VIX that's relatively low, lower than yesterday, in the mid 20s, but that's still a sign that there's some risk. There's some risk seeming to develop in Europe, and in the currency market, the yen is not strengthening through most of the night. Only the last hour or so has it been strengthening. Okay, so with that in mind, when I take a look at the potentiality of this, because VIX is lower, oil still trading, you know, in the 70s, and the yen is weakening. There should be in the open, depending on if some crazy news happens, the open should gap up a little bit. Okay, but like I said, don't trade the first 15 minutes when the market opens. Some people think that they're going to be a hero, but there's a lot of volatility because they're trying to clear orders, buy and sell orders, and there's a lot of volatility going back and forth. So you can make a lot of money and you can lose a lot of money because of that volatility. It's better to just be steady and to be calm and view the market as kind of like fishing. All right. When the water has fish, and there's the weather is just right, and you put your fishing hook in the water, with the bait, you get a fish and you made some money. All right. But not always will you get fish. All right. And that's why you have to just be calm. This is why I said markets are not linear. They're all nonlinear. It's very hard to model. People think that acts where you can model them in some sort of Newtonian closed system. It's not. It's not a closed system. It's an open system. It's chaotic. It's more like surfing or fishing than it is doing quantum, some sort of Newtonian mathematics, because there's a behavioral element, and then there are feedback loops, and there are new things that are coming into the market at any given moment. So I wanted to explain what happened yesterday. Okay. So as I was saying before, the news announcement from Chairman Powell, this Fed news announcement, said there was going to be a 25 basis point. Yesterday, I said it was going to either be most likely 25, but it could be no rate hike at all and just steady, a 25 or a 50. And my memory serves me that I said that if it was 25, that the market would most likely go up, but that you most likely go up, and you don't trade that 15-minute mark. All right. Now, what I didn't say in the video, which I probably should have, and I don't think I said it, was that after 15 minutes of the rate, what happens with the Fed when the Federal Reserve gives a news announcement? They go, okay, we're going 25. So that happened at 2 o'clock, right? But they also release a statement, and the reporters start to read the statement. So, and I didn't go into detail about the statement that they make. I used an umbrella term like announcement. So there's a rate that's announced, and then there's a statement that comes along with it, a written statement. The reporters are reading the statement, and this is the reason why you don't want to trade the 15-minute mark, because it's not just the rate, it's also what's in the statement, if it's bullish or bearish. So while they're reading that statement for that 15 minutes, markets are really volatile, and that's what's happening right here. Okay, markets were the S&P 500 was basically trading, up and down, undulating a little bit, but then there were big candles that started to pop up, right after the rate 25. Oh, bullish. So that's what happened. But there's a lot of volatility. If you look at the VIX at that time, the VIX was also elevating towards the news announcement. Okay. So, there's a lot of volatility going on with that right after that news, trying to understand what is in that statement. So every pundit will go, okay, there's some bullish things in here and there's some bearish things in here. Okay. So it goes up and down, up and down, up and down, right? So after that 15 minutes, then Chairman Powell goes into a room and reads the statement or a statement, and then he takes questions. And during that period of time is about, I think that takes place at around 2:30 or 2:15. I think it's 2:30. And at 2:30, all the way for a half an hour or more, people are asking questions that could be bearish or bullish to the market. This is why I say don't trade the news announcement, because there could be a very bullish number, but a very bearish communication in the statement. All right. Okay. So it's going up. All right. It's somewhat bullish all the way about to 1448 24 hour. So that's like 248 or so. 240, yeah, 248. 248, it peaks, okay, and then it starts to go down. Now, my understanding is, because I was studying, once the news announcement was happening, I stayed away and just looked at my studies, my medical studies. So, so my understanding is that in Congress, Yellen was speaking and talking about how the government isn't thinking about backstop. There was a question that took place where, are you willing to backstop all bank deposits? And she basically said, we don't have any plan to do that. And then one of the congressmen or women asked something like, why? And the answer was basically, they would have to be judged as a systemic risk before we would engage. That may have been part of the reason why there's mean reversions. Markets are finicky. This is why I want to talk about risk management. All right. So, okay. So the market's going up at the 1440 at 248, and then it starts to go down, and it mean reverts a little bit, and then comes down. And you can kind of see almost the 38% retracement that I'm talking about when markets go up and go down and mean revert. There was a little Fibonacci that was going on here, a mini Fibonacci that was being played in this news announcement because of all this volatility that's going on. All right. So, and bounced off of the 38, roughly the 38, maybe 50% retracement. It depends on where you place it. Depends on where you place it. It's probably around the 50. All right. So, so markets did close lower. Now, yesterday I said, if you're an intraday trader or a swing trader and you want to just play this volatility, look at the SPXL long, because that's long. That's when the market's going up, you play that one. If the market's going down, and you play SPXS, which is a short position. All right. So if you're intraday trading and you traded into the statement at let's say 230, you would have gained that 15-minute from 230 to 245. The increase from, if the SPY, you would have gained, if you put your position in at 67.54 and closed it at 67.75, you would have made a pretty good profit. So, but to assume that markets are going to just be monotonic because of a news announcement is crazy. There's a lot of volatility that happens, and then there's a mean reversion that takes place. But you could have made money through that speech from 12:30 to 2:30 to 2:45. All right. But it did go down. Now, let me tell you how I played it. Okay. So I got to log in and see what my position dollar cost averaging is. Hold on. Okay. All right. So what I want to state is that when I give you this information, it's it's to give you kind of a trajectory of where the markets may be going. But you got to pay attention and make your own decision. Never trade all of your account. Never trade all of your account. Only trade about 10 or 20% of your account with a particular position. The reason why is that if you put a position, let's say you thought the market was going up during the Fed day yesterday, and you put a position at, let's say, 68. okay, on the SPXL. If you put all of your trading capital in, that would be stupid, because if it went up, you made money, great. But if it went down, you have no way to buy more positions. So when the mean reversion does take place, that you can benefit from that mean reversion. You'll be waiting longer. So what you want to do is deploy 10 to 20% of your capital at a given trading entry point. Okay. So if the market does go down, then you can buy in at a lower rate. So let's say you put 10% of, for simplicity, let's say you have $200 in your account, all right? And you spent $20 in the account for a position. Let's say that stock was trading at 20, okay? And the stock goes down to 10. You can now take another 20, all right, and buy 2 shares now of that stock. And now you have 3 shares, dollar cost, closer to the 10 than to the 20. So when the mean reversion happens, you get out of the position quicker if you want to get out just at 0, or when it does pass your dollar cost average, you're starting to gain much quicker. So the whole key here is not just looking at indicators. And I think this is what it wasn't explicitly said yesterday, but for me, I think it's just common sense. You don't want to trade your full account, and therefore when the market starts to go down, you're now being able to deploy more of your capital. All right. So never trade in one position all of your trading account. Go in increments of like 10% or 20%, depending on your risk assessment, what you want to absorb in risk. That's dangerous if you're just trading your whole account at once. All right. Because markets, a news announcement that is a black swan, we have black swans happening every day. All right. Some are mini and just affect the market just a little bit. And there are some that are really big that affect the market and last for months, sometimes years. Okay. So anything could happen. A plant could blow up, or a train station, derailment, or a train derailment, or, whatever. Anything could happen during the day that could be positive or negative to the market. All right. So you just got to manage the risk. Okay. So here, so what I did was I did something that was a little bit more complicated. It's something called straddle. All right. Now I said to the audience, buy the market if it's moving up, with SPXL, or if the market's going down, by SPXS. Again, XPSS is more risky than XPSL. So you got to get out of your positions in SPXS faster. Don't hold those, all right? Because the market over time will be moving upward, not downward, the longer you go out with the time frame. So so the markets did go up. All right, so we have all right, so it's now 9:30, okay, and the Dow is up 200 points. And at this moment in time, the VIX is at 20, and oil is trading at 71, and the yen is weakening. Okay, so that looks like a good day. So right at this moment, and the SPXL is going up. All right. So this is what I'm saying. It's like you pay attention to the indicators, but again, this is the first 15 minutes. It's not really good to buy into the first 15 minutes if you really, don't want to be hit by a bunch of mini black swans. But all right, so this is bullish, what we're seeing at this moment. So we're seeing this in all real time. The market just opened 4 minutes ago, okay, in New York. All right, so what I did yesterday was I did a complicated position strategy. I went into the market long and short for oil, right? It's called a straddle, all right? It's kind of a straddle position. Straddles are usually done in option markets, but I'm doing this type of strategy with the ETF. And one leg is going long. Do not do this unless you are a wealthy person and you are very knowledgeable about markets, that have lots of experience. All right. Do not do what I did unless you have money and you have a lot of financial experience, a lot, like not just trading simple equities, but have traded options and futures and portfolios that had millions and millions of dollars in it. So, so don't do what I did, but I'll explain what I did so you can kind of learn half of the strategy. So what I did was when the thing settled after the 15 minutes before the news announcement, what I did was I did a long and short position in oil. So I bought Gush and I bought Drip. Now people would say, well, you're going to lose money on one side and you're going to lose money on the other. Remember what I said, do not trade your full account. So if I take 10% of my trading position, of my trading money, right? 10% of that goes to Drip and 10% of it goes to Gush. Either way, I make money, and then I take the profits from one and to buy out of the position or use the reserve capital that I have to buy out. So this is what happened. So right at this moment in time, I have a dollar cost averaging on Drip, which was a short position on oil. That dollar cost averaging was at 1564. When it closed yesterday, it was profitable because the market started to mean revert, right, and go down. So that was profitable. And Gush was not as profitable yesterday because that's a long position in oil. Okay, so we had kind of a decrease in oil later in the trading session yesterday. So my dollar cost averaging for that is 1720. Okay, so right now, at this moment in time, Drip is in what is called in the money, and Gush is out of the money. So what I'm going to be doing is I'm going to look at the trading day as it is evolving, and buy more shares of the losing leg of the straddle. And then when I decide to close out, the winning position, then I'll take that money and move more money into the losing leg as the market is starting to mean revert. In this case, I'm in the money for Drip and out of the money in Gush. But as the market continues, if it continues to go up, if I hold my Drip position, what will happen is Drip will become out of the money and Gush will be in the money. So this is another strategy. Do not do this unless you have money, a lot of it, and you understand markets at a very professional level. All right, at an institutional professional trading level. All right, but you can take this strategy for one leg. So if you bought SP, the point I'm making here is if you bought yesterday SPXL at 68 and it started to go down, and now it's at, let's say it closed at 64. Okay, so you had $4 loss per share. All right, well, because you only use 10% of your capital deployed, now would be a good time to buy, and you got a better dollar cost average, and then wait for the mean reversion, and then bam, you got more money. So if someone says, well, the market still closed yesterday, down, markets are going to go up and down in the intraday, all right, depending on where you look in the thing. Plus you have a lot of these other things that are not planned. So 25 basis points was a bullish sign in the market when it was being announced by the Fed. But when Yellen was talking to Congress Yellen is from the Treasury, they scared markets. She scared markets because she was basically stating in a news announcement that not all banks are protected FDIC. All right. Well, that wasn't known that that was going to happen. This is why I keep on saying you got to pay attention to the news and never trade all of your account. So hopefully you've learned about risk management. Don't trade more than 10% per position. Don't do crazy hedging unless you're very professional and have lots of money. And you know what? Just ease into it. The Fed announcement went up, and if you played it right, you would have made some money in 15. The 15 minutes right after. If you started trading at 2:30 or 2:15, and you closed it out at 2:45, you would have made money. All right, that was 45 minutes. You would have made a decent earning. All right, but it did go down. All right, if you held the position, then what you want to do is dollar cost average into it, and then the market's now at 66. So if you were at 68 and you bought some more at 64, you would have been around 68. So you'd be around you would be around 68, 64. So let's say, about 66 or so. You would be almost broke even at this moment in time if you did the strategy that I'm talking about. So you got to kind of like play the reserve money. It's like energy. All right, okay. It's kind of like almost playing the Nintendo. If you're playing a guy and he's losing energy, you can get more energy, right? Well, the cash that's in your trading account is the energy to deploy to get a better cost dollar average position as the market is moving, upward for you in that particular stock that you've invested in or whatever, or traded in. Okay, so hopefully you understand the indicators. The market is up right now, and but it's the first 15 minutes, like right now. All right, it's within the first 15 minutes, and it's mean reverting back a little bit. Okay, again, wait the first 15 minutes and just see how the market is going. But at this moment in time, markets did go up in the morning open. Could go down, could go up. That's why I keep on saying, if you look at it and you see the trend, you can play both sides. You can make money when the market's going down, and you can make money when the market is going up with SPXL and SPXS. That's how you do it. All right. So good luck with it. Not every day is going to be a positive day for you. And that's why you have to deploy additional capital in your trading account to be able to get a better position. Never trade all of your money. Never, ever, 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 ever do that. All right. Because you want to be able to capitalize on a movement. This is trading. What I'm talking about is trading. All right. So please pay attention to me. You'll do fine. All right. And hopefully I explained that, markets can go up and down, especially in unknown speeches from, certain people like the Treasury Department or, some new event that takes place in the market. All right. So, but there's going to be a lot of volatility. That's why you don't want to play that. You don't want to play that first 15 minutes. First 15 minutes is crazy. It could go up, it could go down. You can make money, you can lose money. And the farther away from the actual statement by the Federal Reserve, which is usually at 2:30, the farther away you are from that, the more you understand where the trend is. So if you didn't start trading until 3 o'clock, so you only had 1 hour of trading and to put a position in, then you would have known that at three, that the market was just about starting to do a little bit of a mean reversion up. But it was bottoming out and was doing a little mean reversion up, and then at about 320, it started to go back down. So that would have been a good, around there would have been a good time to buy. All right. Why? Because at that moment in time, you didn't know if it was going to flatline, if it was going to go slightly up or slightly down. But with a 10% deployment of cash, then you would be able to buy more right before the end of trading day, or capitalize on the mean reversion up. Maybe today, we'll see. Right now it's up. It's now at 66. So hopefully that explains on how to kind of trade this volatility that's happening. All right. So thank you for listening and have a nice day. Oh, by the way, please subscribe to all my channels. I have 3 YouTube channels. I have Brighteon, Bitchute, and Rumble. And go to my store, the-studio-reykjavik.com, and please purchase the products, the health products that I offer. I have nano silvers, liquids and gels, and I have a nano silver toothpaste, best toothpaste that you'll be able to get. I have C60, which is a very strong antioxidant that you should take every day. They'll improve your health and slower down aging. And I partnered up with Boomer Products, and I have a ton of supplements, B vitamins, vitamin C, zinc, turmeric, ashwagandha, clarity factor, collagen, lignans, digestive enzymes, probiotics, pre and probiotics, a lot of stuff. I have a lot of stuff there. And then I have a all natural deodorant bar. Excuse me, all natural deodorant bar that will that doesn't have any aluminum in it, no aluminum. It's made with essential oils that came from the Himalayas. Very high quality ingredients. It's a little pricey, but at $22 a deodorant bar, when you use it, you'll realize that how high quality it is. Again, everything I sell is high quality. Thank you for listening. Please subscribe to all my channels. Please go to my store, the-studio-reykjavik.com. Use the discount code, all caps, discount 5. You get $5 off. That will reduce the shipping cost for you. And hey, you know what? That's how you move forward. Improve your health. Take advantage of the markets. Don't be a victim of the inflation that's happening. I just told you how to make markets when they're up and down. All right. So please support my work. Go to my store, the-studio-reykjavik.com, and make sure that you subscribe to all my channels, all YouTube channels, Bitchute, Rumble, Brighteon. All the links are in the description of every video. Thank you for listening and have a nice day.